All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be going over ticker ABBV, Abbvie Pharmaceutical, company we've definitely covered a couple times before, at least in part. It's also been a holding of mine for quite a decent long time. We bought it when it was at some of its lows a few years back. It's performed very well for us. Oh, Mikey, get down. Go. Just a second. Sorry about that. I could tell my cat was like about to go hairball mode. I did not want him to be on the desk when that happened. He's all mad at me, but whatever. Okay, anyway, as I was saying, weird way to start the stream, but better than having him hairball all over me or my desk in the middle of it. Anyway, so Abbvie Pharmaceutical, we've owned it for a decent amount of time, and it's performed really, really well. I have actually trimmed the position a little bit in the recent months, but still holding a decently large amount of the overall position that we had built. I was definitely kind of hesitant to sell out of the position, even though it definitely had gone up to a lot of its peak levels according to the last valuation that we had did. But I knew that we were going to be getting a 10K soon, so I definitely wanted to see what the valuation kind of looked like after that before selling out of more of it. Because like I said, I definitely have enjoyed having this position. I have a lot of confidence in the management and the overall plan that they have, as well as it's being in the pharmaceutical space under certain types of market positions, it's a relatively defensive position. Because medicine, people are gonna buy that under most market conditions. So either way, I will kind of comment on our watch list a little bit before we get started, which is to say, yesterday when we were streaming, I had said that I thought today we were probably gonna be doing Jeffries because I didn't see that this 10K had come out until basically right after the stream. I went and checked all the 10Ks for this list and saw that this 10K had come out for Abbvie as well as the one for BPL, so that one's definitely on the docket for the near future as well. Plus, who knows what will come out over the weekend. So we have definitely a few things to do over the next few streams, which is part of the reason that we had set up to do some Saturday streams in the first place. So anyway, back with Abbvie, now that I kind of explained how we got onto this company in the first place, the prep work in general that we usually cover, they have a $76.9 billion worth of book listed debt at a weighted average maturity of 9 years and an interest rate of 3.17%. Their interest rate actually moved up a little bit this year relative to the last year, but they pushed the maturity out by 1 year. Excuse me. And that's on the back of having grown the debt pretty significantly. However, they've also grown their market cap very significantly last year, as we've discussed. So the debt to equity ratio has actually improved, even though they've increased their debt on net. And they have increased the revenues and their income pretty significantly as well. So that's pretty well backed up. Though obviously there's a lot of questions to be had about the revenue. The main component of their drug portfolio that is the hugest chunk of the revenues is Humira, what's it called? Medication for god damn it, the bone sickness. Oh man, the word just like totally left my brain. Now I'm feeling like a total idiot. God damn it, man! I even have like minor or early onset of it. God damn it. Words, sometimes words just leave your mind. Humira, oh my gosh, now I feel like I swear I know what this drug is. Like a complete idiot. God, fuck. What's the word? It's like a bone and joint degenerative disease. God damn it. Whatever. I will remember in a few minutes. Arthritis. God damn it. I'm sitting there like rheumatoid arthritis. God damn it. I don't know why I couldn't remember the word. Arthritis. It's the most popular arthritis medication and it's also the most taken medication in the United States by prescription. But that medication is going to be going off patent within the next year or two, so there's a decent amount of uncertainties surrounding their ability to replace those revenues, which we have built a revenue model for projecting a few of the drugs that they have on their portfolio, as well as the decline of those revenues, which we'll get into after we do the numbers. So I did already cover the book listed debt. Segmentation is relatively simple. We're just using the pharma category, which has an unlevered beta of 0.91 and a sales capital ratio of 0.69 and a net margin of 28.62, which I'm pretty sure they have about that net margin after R&D capitalization, maybe a little bit higher or a little bit lower. I'm not 100% sure, and I can't remember where their sales capital ratio is. In the most recent year, it's a little bit below that. Okay, but we'll see what that comes out to be on our projections on whole, as well as, like I said, I already did the first year of their numbers, which it was pretty interesting to see the overall changeover. I do know that compared to the last year numbers, the margin did jump pretty significantly, as well as the overall EPS. So I will play the fourth quarter earnings call while I work on the rest of the numbers, as I normally do.
Hi, welcome to the AbbVie fourth quarter 2021 earnings conference call. All participants will be able to listen only until the question and answer portion of this call. You may ask a question by pressing star 1 on your phone. I would now like to introduce Ms. Liz Shea, Vice President, Head of Investor Relations.
Good morning, and thanks for joining us. Also on the call with me today are Rick Gonzalez, Chairman of the Board and Chief Executive Officer, Michael Severino, Vice Chairman and President, Rob Michael, Vice Chairman, Finance and Commercial Operations and Chief Financial Officer, and Jeff Stewart, Executive Vice President, Chief Commercial Officer. Joining us for the Q&A portion of the call is Laura Schumacher, Vice Chairman, External Affairs, Chief Legal Officer, and Corporate Secretary. Before we get started, some statements we make today may be considered forward-looking statements for purposes of the Private Securities Litigation Reform Act of 1995. AbbVie cautions that these forward-looking statements are subject to risks and uncertainties that may cause actual results to differ materially from those indicated in the forward-looking statements. Additional information about these risks and uncertainties is included in our SEC filings. AbbVie undertakes no obligation to update these forward-looking statements except
Until my cat's mad at me for
on today's conference call, non-GAAP financial measures will be used to help investors understand AbbVie's business performance. These non-GAAP financial measures are reconciled with comparable GAAP financial measures in our earnings release and regulatory filings from today, which can be found on our website. Unless otherwise noted, our commentary on sales growth is on a comparable basis, which includes full current year and historical results for Allergan. For this comparison of underlying performance, all historically reported Allergan revenues have been recast to conform to AbbVie's revenue recognition accounting policies and exclude the divestitures of Zenpep and Biocase. References to operational growth further excludes the impact of exchange. Following our prepared remarks, we'll take your questions. So with that, I'll now turn the call over to Rick.
Thank you, Liz. Good morning, everyone, and thank you for joining us today. I'll provide perspective on our overall performance and outlook, and then Jeff, Mike, and Rob will review our quarterly business highlights, pipeline progress, financial results, and guidance for 2022 in more detail. Our performance this quarter tops off another excellent year for AbbVie, with results well above our initial expectations. We delivered full year 2021 adjusted earnings per share of $12.70, representing growth of more than 20% versus the prior year. Full year adjusted net revenues were more than $56 billion, up 10.5% on a comparable operational basis. These results demonstrate balanced performance across each of our major growth franchises, including double-digit comparable operational revenue growth from immunology, aesthetics, and neuroscience. I'm extremely pleased with our momentum, and we've entered this year in a strong position, which is reflected in our guidance. We anticipate 2022 adjusted earnings per share of $14 to $14.20, representing growth of 11% at the midpoint. Longer term, we remain well-positioned with an impressive set of diversified growth assets. In immunology, Skyrizi and Rinvoq are already contributing meaningful revenue, including $4.6 billion in combined sales last year, with substantial growth anticipated in 2022 and beyond. Over the next few months, we expect to add several new indications to the list of approved uses for these two assets, at which point Skyrizi and Rinvoq will be commercialized across all of Humira's major indications, plus atopic dermatitis.
Skyrizi and Rinvoq are the two main drugs that we're going to be projecting based off of.
And the robust data we've demonstrated across our broad development programs, we expect combined peak sales for Skyrizi and Rinvoq to exceed the peak revenues achieved by Humira. In hematological oncology, we've established a leading position with Imbruvica and Venclexta, which are both expected to remain important revenue contributors through the decade. To support our next wave of growth, we also have an exciting and diverse pipeline of promising new therapies to address critical unmet needs in both blood cancers and solid tumors. Notable opportunities from our mid to late-stage oncology pipeline include navitoclax for myelofibrosis, which has the potential to provide disease modification in a market where current treatments only address symptoms. Epcoritamab, a potentially best-in-class CD3 by CD20 for B-cell malignancies, including DLBCL and follicular lymphoma. ABBV 383, our BCMA CD3 bispecific, which has the potential to become a best-in-class treatment in multiple myeloma. And Teliso-V, our promising c-Met ADC being studied for non-squamous, non-small cell lung cancer, which was recently granted breakthrough therapy designation. In neuroscience, we have a portfolio of compelling and differentiated therapies to support robust long-term growth in migraine, Parkinson's disease, and psychiatric conditions. Ubrelvy and Qulipta are both demonstrating strong launch trajectories in migraine, with each treatment expected to contribute more than $1 billion in peak sales. Valar continues to have a significant opportunity with currently approved indications, with peak sales expected to approach $4 billion. An approval in major depressive disorder represents upside to our current projections. And 951, a potentially transformative improvement to our current treatment options for patients with advanced Parkinson's disease, with peak sales also anticipated to be more than $1 billion. Our leading aesthetics portfolio represents another extremely attractive growth opportunity. This business is performing well above expectations, delivering full year 2021 sales of more than $5.2 billion, $700 million higher than our initial guidance. AbbVie's increased promotional investment are driving accelerated category growth, especially in toxins and fillers, where there is substantial room for additional market penetration globally. Dedicated resources are also focused on delivering new product innovation within aesthetics, with several exciting R&D programs internally, including both short-acting and long-acting toxins, as well as novel fillers with biostimulatory or regenerative features. And we remain active with business development to pursue promising external technologies and complementary opportunities, including the recently closed Soliton acquisition, which further expands our body contouring portfolio. Given this focus and investment, we expect our aesthetics franchise to deliver high single-digit revenue growth through the end of the decade, including sales of more than $9 billion in 2029. Lastly, we've developed a robust pipeline, including numerous attractive late-stage programs, novel early-stage therapies, and a growing range of potential platform technologies, which we expect will collectively contribute to our growth through the decade. With the actions that we've taken to diversify our sources of growth, we remain very confident in the long-term outlook for our business. Following the U.S. Humira LOE event in 2023, we expect to quickly return to growth in 2024 and deliver high single-digit growth from 2025 to the end of the decade. This is a testament to the strength of AbbVie's broad and balanced portfolio. In summary, this is an exciting time for our company. We're demonstrating excellent execution across our portfolio, and our long-term growth prospects remain very strong. With that, I'll turn the call over to Jeff. Jeff?
Thank you, Rick. Looking at our quarterly results, we continue to demonstrate excellent commercial execution across our therapeutic portfolio. I'll start with immunology, which delivered global revenues of more than $6.7 billion, reflecting growth of 13.3% on an operational basis. Global Humira sales were $5.3 billion, up 3.5%, with 6% revenue growth in the U.S., offset by biosimilar competition across the international markets, where revenues were down 8.8% on an operational basis. Skyrizi is performing extremely well. Global sales of nearly $900 million were up 12.4% on a sequential basis, reflecting continued market share gains. Skyrizi has now surpassed Humira as the leader for total prescriptions in the U.S. psoriasis biological market, with share of approximately 20%. We are also now leading the market in several international geographies, including Japan. Total in-play share, which includes both new and switching patients, remains very strong and now reflects roughly 37% patient share in the U.S., as well as leadership in nearly 20 key countries around the world. Skyrizi is also now approved for its second major indication, to treat adults with active psoriatic arthritis, further enhancing its compelling profile in dermatology. Field promotion is now active globally, and early feedback from physicians has been very positive, given Skyrizi's demonstrated skin clearance and joint efficacy in our PSA clinical program. With nearly 30% of patients visiting dermatologists having both skin and joint involvement, this new approval will sustain Skyrizi's strong momentum. In addition, we are preparing for the launch of Skyrizi in Crohn's disease, an indication with very meaningful long-term revenue potential, with regulatory approvals in both the U.S. and Europe anticipated this year.
And Crohn's disease is very, very
continues
prevalent.
To demonstrate robust growth. Global sales of more than $500 million were up 14% on a sequential basis. Prescriptions in RA remain strong, with a total market share of more than 5.5% in the U.S. and nearly 5% across key international markets. We're very pleased with the competitive labels for both PSA and atopic dermatitis, where we are making excellent progress with their launches globally. In atopic dermatitis, dermatologists appreciate key elements of Rinvoq's new label, including the incorporation of stringent skin and itch endpoints, reflective of the performance in our registrational trials, as well as an adolescent indication and dosing flexibility. Managed care access is expected to ramp fairly quickly for both atopic dermatitis and PSA in the U.S. We are also preparing for the launches of Rinvoq in ulcerative colitis and axial SpA, with regulatory approvals for both indications anticipated this year as well. Overall, we continue to feel very good about the performance and progress we are making with both Rinvoq and Skyrizi, which are expected to contribute more than $15 billion in combined risk-adjusted global sales in 2025. In hematologic oncology, global revenues were nearly $1.9 billion, up 4.7% on an operational basis. Venclexta once again delivered robust growth. Sales were up 34% on an operational basis, with strong share performance across all approved indications. Imbruvica global revenues were down 2.7%, reflecting a slower than anticipated market recovery in CLL and increased share pressure from newer therapies. In neuroscience, revenues were more than $1.6 billion, up 19% on an operational basis, including robust double-digit growth for both Vraylar and Botox therapeutic. I'm also very pleased with our performance in migraine, where we have a portfolio of multiple distinct therapies to address the full spectrum of this disease. This includes our two leading oral CGRP therapies. Ubrelvy for acute migraine, which delivered total sales of $183 million, up 13% on a sequential basis. We anticipate robust sales growth again this year based on Ubrelvy's competitive profile, continued strong new patient starts, and a rapidly expanding CGRP segment. And we also have Qulipta, the only oral CGRP treatment specifically developed for the prevention of episodic migraine. The launch is going extremely well. When considering both paid and bridge volume, Qulipta is already capturing nearly 20% of the new-to-brand share in the preventative CGRP class. Roughly 3 months post-launch, this is an incredible accomplishment, and it's a testament to Qulipta's demonstrated efficacy, including rapid and meaningful reduction in migraine days. We expect commercial access for Qulipta to ramp quickly in the first half of this year. In eye care, revenues of $960 million were up 3.9% on an operational basis, including $364 million in sales from Restasis. Lastly, Mavyret sales were $427 million, down 10.1% on an operational basis, as treated patient volumes remain suppressed compared to pre-COVID levels. Overall, I'm very pleased with the performance and the momentum across the therapeutic portfolio. And with that, I'll turn the call over to Mike for additional comments on our R&D programs. Mike?
Thank you, Jeff. We made significant advancement across all.
Right, one more year, we'll do our 5-year trend.
And we expect continued progress again this year. In immunology, we had several recent important regulatory updates. We implemented safety and indication updates to our RA label for Rinvoq, and also received FDA approval in psoriatic arthritis and atopic dermatitis, securing strong labels that highlight Rinvoq's favorable benefit-risk profile in both new indications. In atopic dermatitis, we received approval for both the 15 and 30 milligram doses, and based on the impressive levels of skin clearance and itch reduction demonstrated in our development program, we believe Rinvoq will be an important new treatment option for adult and adolescent patients with moderate to severe atopic dermatitis who have not responded well to other systemic agents, such as cyclosporin, methotrexate, azathioprine, or biologics. We also have regulatory applications under review for Rinvoq in ulcerative colitis, ankylosing spondylitis, and non-radiographic axial SpA. We expect an FDA approval decision next month for ulcerative colitis, in the second quarter for ankylosing spondylitis, and in the fourth quarter for non-radiographic axial SpA. In Europe, we anticipate approval decisions for ulcerative colitis and non-radiographic axial SpA in the second half of the year. We're nearing completion of Rinvoq's registrational program in Crohn's disease, which is the last major indication expansion program for Rinvoq. We recently announced positive top-line results from the first phase 3 Crohn's induction study, where Rinvoq demonstrated a very strong impact on clinical remission and endoscopic response in a difficult-to-treat refractory patient population. We expect to see results from the second phase 3 Crohn's induction study and from the maintenance study in the first half of this year, with regulatory submissions anticipated in the second half of 2022. Also in immunology, we recently received FDA approval for Skyrizi in psoriatic arthritis, an important indication expansion for this asset. Based on the strong joint efficacy and the high level of skin clearance that Skyrizi provided in our registrational trials, we believe Skyrizi will be very competitively positioned as an effective new treatment option for psoriatic arthritis patients. We also have regulatory applications under review for Skyrizi in Crohn's disease, with approval decisions expected in the U.S. next month, and in Europe later this year. We've seen impressive results in our Crohn's disease program, and we believe Skyrizi has the potential to become an important new therapy in this market, where there continues to be considerable unmet need. We're making very good progress with our early-stage immunology pipeline as well, where we are developing novel agents with the goal of significantly advancing the standard of care across our core areas by providing deeper and more durable responses. Our anti-TNF steroid ADC, ABBV 154, is a novel approach for delivering a potent steroid that has the potential to provide durable remission in diseases such as RA, PMR, and Crohn's disease. We expect to see preliminary data from our phase 2 dose-ranging study in RA in the fourth quarter of this year. We also expect to see phase 2 proof-of-concept data in PMR and Crohn's disease in 2023. In dermatology, our early-stage efforts are focused on developing oral agents that can provide clear skin with durable responses. Our ROR gamma T inverse agonist, ABBV 157, is designed to more effectively inhibit IL-17 production compared to pure antagonists, which has the potential to result in a greater impact on skin inflammation. We recently began a phase 2 dose-ranging study for 157 in psoriasis. Moving to oncology, where we continue to make good progress across all stages of our pipeline. We recently received an FDA breakthrough therapy designation for Teliso-V in second-line plus advanced or metastatic non-squamous non-small cell lung cancer. Based on
We'll go ahead and stop them there, and we'll cover our 5-year trend. A few little slips there, took a little bit longer than I hoped, but hopefully we can keep things moving a little bit. Looking at the sales to capital ratio, as I was saying before, they did used to have a sales to capital ratio that was higher than the industrial expectation that we have for them in the 0.6s kind of range. It's only in the most recent couple of years it's been much significantly lower than that, and that's post their Allergan acquisition. They did make a very large both stock and cash acquisition. Part of the reason that their debt had even jumped up very significantly over the period that we watched. But they did get a huge amount of revenues as a result of it, and then that is also the diversification of the revenue base that the CEO was talking about. Definitely one of the things that I was very hopeful for is like there was a lot of concerns about the Humira patent going off when I was first investing in it, and there didn't seem to be a huge amount of certainty that Rinvoq and Skyrizi was going to be able to replace them, and there wasn't a huge amount of other diversification in them. And then in the time since I've been investing with them, as he said, they've gotten some significant revenues off of Skyrizi and Rinvoq, and also enough to project basically a pretty successful path of replacing Humira, or vast majority replacing Humira using those two, as well as then they did the Allergan acquisition, which is a pretty good significant aesthetics-based growth path, which is a totally different side industry, so it's a good diversification avenue for them. But that has come with a lower sales to capital ratio in the short run, and the idea is, well, are they going to be able to expand that back up in later on? And even if they don't be able to expand this, does that at least get them high revenues and margins to counteract that, which we'll get into. As you can see, they were trading at a pretty high point at multiple points here, except for some points where they traded a little bit cheaper, which was the point to be buying in them at. And then the more recent year, they were trading a little bit more expensive, and now they're relatively cheaper compared to that because their earnings have come up. But there is expectations that after one more year of good growth, there's expectations that those revenues and earnings will go down the year after that because of the Humira patent going off, though then it's supposed to go back to growth again immediately after. So it's really supposed to be a little bit of a bumpy path for the next 3 years, but overall over a 5-year span, there's pretty significant growth expected here. It's just you're going to have to sit through the bumpiness, which does mean there's probably going to be some volatility, which also means better points to buy cheaper shares. And there's a good healthy dividend while you wait, so no big deal. Either way, you can kind of see the shareholders' equity. It was a little low and getting even worse as they were doing heavy share buybacks prior to doing the acquisition, and they ended up with a negative shareholders equity even though the retained earnings was still in positive territory. And then they did do the acquisition, which actually put their balance sheet into a little bit more of a positive territory, though it is now with even less retained earnings. So that at least gets them into a position to get their overall balance back into a better place on the long run. And as you can see, that has come at the cost of expanding their debt pretty significantly over this 5-year period, though you can see there has been work to at least move it downward in the most recent year. And as a result of that, there's also been a huge expansion of their overall asset base, a huge chunk of that coming from their intangible asset base. So basically half of their assets is just intangible assets. So, that's just par for the course. Pretty high levels of return on invested capital in the past prior to the acquisition, a little bit lower in the more recent years, though it is starting to expand in the more recent years since then. And the same thing can be said for the returns on equity. Their overall leverage profile has been pretty good. The thought was that they might have had too much debt to be able to handle the decline in the Humira revenues, and now it's shown that actually they probably managed to have just the right amount of debt, and now the leverage is paying off with massive returns on equity. Which we'll see as the overall equity base starts to expand. Looking at the cash flow, you can see over the 5-year period, the total amount of cash flow that they should have been able to pay to their shareholders was about $38.6 billion. And the total amount that they did pay to their shareholders was $48.2 billion. So they did overpay their shareholders by about $12 billion or so, which, as I said, you can see that they were overpaying in the years prior to the acquisition, especially this right here can be said to be the bulk issue of it, because $17.5 billion was paid out in 1 year, 2018. So obviously that was kind of the big issue, but you could also argue that they were buying it cheap. So you could argue that risk paid off for them. Moving up the line, we can see that we do have a couple years relatively accurate on the R&D capitalization, and it gets us into the range of 23 to 24 or 25% over a 3-year range, though these numbers are not quite fully accurate yet. So we'll see what it looks like after a total 10-year period. You can see it's a little bit lower than perhaps the overall expectation on the industrial expectation, which means they're a little bit lower on both the sales to capital ratio and the margins, but they did just make those huge acquisitions. So there's still room for them to expand those things as things move forward. Not to mention as the numbers come down on Humira, the margins on Skyrizi and Rinvoq will probably expand as well. And we'll see up here, listed numbers look relatively accurate. What was the listed debt? I can't even, it was 3%. We'll go ahead and leave it up at the higher number for now. I think that's probably accurate. And then tax rate, we're definitely have to mess with that, but we'll go ahead and just slap a times 5 in there to get it at least into double-digit range. Well, I guess more, but 10 to, oh, whoa, what did I do? Oh, excuse me. So get it over 10 to 11% at least. That should be better for a more perpetual range. All right, so we'll go back to the earnings call while I finish up the last 5 years of numbers.
On the encouraging results we've seen to date in our clinical program. Treatment options for patients who have exhausted platinum-based chemotherapy, immunotherapy, and targeted therapy are limited to single-agent chemo, which typically provides response rates of only 15 to 20%, with a median overall survival of less than 1 year. Prognosis for these patients is very poor. While targeted therapies have been approved by the FDA for the 3 to 4% of non-small cell lung cancer patients harboring MET exon 14 skipping mutations, there are currently no therapies approved specifically for the much larger group of patients who exhibit c-MET protein overexpression. Patients with overexpressed c-MET represent about 25 to 30% of the advanced or metastatic non-squamous non-small cell lung cancer population with wild-type EGFR, which corresponds to an incidence of approximately 35,000 patients each year in the U.S. In stage 1 of our phase 2 study, we saw promising efficacy in heavily pretreated patients who received Teliso-V, including a 54% objective response rate in those with highly expressed c-MET. The second stage of the phase 2 study is ongoing and has the potential to support an accelerated approval in second-line plus advanced metastatic non-squamous non-small cell lung cancer. We expect to see additional data from this study next year. We also recently began the clinical program for our next generation c-MET ADC, ABBV 400, which utilizes a more potent topoisomerase inhibitor payload to potentially drive deeper tumor responses in patients with both intermediate and high levels of c-MET expression. We also expect to see data this year from several important indication expansion programs for Venclexta, including results from the phase 3 CANOVA trial in relapsed refractory multiple myeloma patients with the T1114 mutation, as well as results from our program for Venclexta in previously untreated higher risk MDS patients, where we received a breakthrough therapy designation. We plan to submit our regulatory applications to the FDA in the first half of this year for an accelerated approval in MDS and late in 22 or early 23 for multiple myeloma. Both indications represent important expansion opportunities for Venclexta and will help drive long-term growth for our oncology portfolio. We are also making very good progress with epcoritamab, where we continue to generate strong data in early-stage studies to support our view that epcoritamab has the potential to become a differentiated and best-in-class CD3 by CD20 bispecific across several B-cell malignancies, including diffuse B-cell and follicular lymphomas. We'll see monotherapy data in the third quarter from the phase 2 expansion cohort in DLBCL, which has the potential to support a submission for accelerated approval in the second half of this year. We also have a phase 3 study ongoing in third-line relapse refractory DLBCL, and we plan to initiate several additional phase 3 trials this year, including studies in earlier lines of therapy for diffuse B-cell lymphoma in multiple combinations, as well as in follicular lymphoma in combination with rituximab and Revlimid. This year, we'll also see additional data maturing from our cohort expansion studies for ABBV 383, both as a monotherapy and in combinations with standard of care and novel agents in multiple myeloma. We believe our BCMA CD3 bispecific has the potential to be differentiated on efficacy, safety, and dosing interval, and can be best in class across multiple lines of therapy. We plan to initiate phase 3 studies later this year in relapse refractory multiple myeloma. We also continue to make good progress with navitoclax in myelofibrosis, where we've seen strong mid-stage data supporting our view that navitoclax has the potential to provide disease modification, which we believe will lead to improved and durable clinical outcomes for patients. We expect a phase 3 data readout and regulatory submissions in the first half of next year, with approval anticipated near the end of 2023. Moving to neuroscience, where we expect several important pipeline events in 2022 as well. We recently completed discussions with the FDA and are preparing to submit our application for Vraylar as an adjunctive treatment for major depressive disorder. Based on the totality of the data and the strong benefit-risk profile demonstrated in our clinical program, we believe Vraylar has the potential to be competitively positioned as an adjunctive treatment for major depressive disorder. We expect a submission in the first quarter and an approval.
Must have done something wrong in the liabilities. Yeah, they have a lot of interesting drugs.
We've also completed our registration-enabling program for ABBV 951, our novel subcutaneous levodopa-carbidopa delivery system for treatment of advanced Parkinson's disease.
Oh, there we go. Is that it?
In our phase 3 studies, 951 proved superior to oral levodopa-carbidopa in reducing motor fluctuations in this advanced population, and we believe our innovative new delivery system represents a potentially transformative improvement to current treatment options. We remain on track to submit our regulatory applications in the first half of this year in the U.S. and Europe, with both approval decisions anticipated in early 2023. And we expect to see phase 3 data for Qulipta in chronic migraine prevention later in the first quarter, and plan to submit our regulatory applications in both the U.S. and Europe this summer, with approval decisions expected in the first half of 2023. So in summary, we remain focused on continuing to execute on our pipeline programs and anticipate numerous important regulatory and clinical milestones across all stages of our pipeline in 2022. This includes important indication expansions for on-market drugs and data readouts and regulatory actions for key late-stage assets, as well as proof of concept data from several early-stage NME programs.
You have a genetics degree? That's pretty interesting.
I'll turn the call over to Rob for additional comments on our fourth quarter performance and our 2022 financial outlook. Rob?
Thank you, Mike. AbbVie once again delivered outstanding performance while also advancing our strategic priorities. The strong results across our portfolio continue to support AbbVie's long-term growth outlook. Starting with fourth quarter results, we reported adjusted earnings per share of $3.31, up 13.4% compared to prior year and 5 cents above our guidance midpoint. Total adjusted net revenues were $14.9 billion, up 7.5% on an operational basis, excluding a 0.1% unfavorable impact from foreign exchange. The adjusted operating margin ratio was 49.3% of sales, an improvement of 240 basis points versus the prior year. This includes adjusted gross margin of 83.6% of sales, adjusted R&D investment of 12.1% of sales, and adjusted SG&A expense of 22.2% of sales.
Whoops.
Net interest expense was $571 million, and the adjusted tax rate was 12.5%. Shifting to 2022, our full-year adjusted earnings per share guidance is between $14 and $14.20, reflecting growth of 11% at the midpoint. Excluded from this guidance is $4.74 of known intangible amortization and specified items. We expect adjusted net revenue of approximately $60 billion. At current rates,
the EPS is perhaps a little misleading in the short term,
on full-year sales growth.
We'll get to that.
This revenue forecast comprehends the following approximate assumptions for our key products and therapeutic areas. We expect immunology global sales to grow double digits, including U.S. Humira growth of 8%, international Humira revenue of $2.6 billion at current exchange rates, Skyrizi global sales of $4.4 billion, and Rinvoq global sales of $2.7 billion. In hematologic oncology, we expect Venclexta global sales of $2.3 billion and Imbruvica global revenue of $5.4 billion. The Imbruvica forecast assumes market recovery in CLL, offset by share erosion from increased competition. For aesthetics, we expect global sales of $5.9 billion, including $2.6 billion from Botox Cosmetic and $1.7 billion from Juvederm. For neuroscience, we expect global revenue of $6.9 billion, including Botox therapeutic sales of $2.7 billion, Vraylar sales of $2.2 billion, Ubrelvy sales of $800 million, and Qulipta sales of $200 million, with commercial access increasing rapidly in the first half of the year. For eye care, we expect global sales of $2.9 billion, including $700 million from Restasis, which assumes no generic competition in the first half of 2022. Lastly,
where do I work?
We expect Maverick
I'm
global
a student.
revenue of $1.7 billion. Looking at the P&L for 2022, we are forecasting
Unless you're asking the guy with the
gross margin
genetics
of
degree where he works, I'm not sure.
84% of sales, adjusted R&D investment of approximately $6.8 billion, and adjusted SG&A expense of approximately $12.7 billion. This guidance includes approximately $2.5 billion in expense synergies from the Allergan acquisition. We are forecasting the adjusted operating margin ratio to expand by 120 basis points to approximately 51.5% of sales. We expect adjusted net interest expense approaching $2.2 billion, our non-GAAP tax rate to be approximately 12.7%, and our share count to be roughly flat to 2021. Turning to the first quarter, we anticipate net revenue approaching $13.5 billion. At current rates, we expect foreign exchange to have a 1.3% unfavorable impact on sales growth. This revenue forecast comprehends the following approximate assumptions for our key therapeutic areas. Immunology sales of $6.2 billion, Hem/Onc revenue of $1.7 billion, aesthetic sales of $1.3 billion, neuroscience revenue of $1.5 billion, and eye care sales of $900 million. We are forecasting an adjusted operating margin ratio of approximately 51% of sales, and we model a non-GAAP tax rate of 12.4%. We expect adjusted earnings per share between $3.10 and $3.14, excluding approximately $1.22 of known intangible amortization and specified items. Finally, AbbVie's strong business performance and outlook continues to support our capital allocation priorities. We expect to generate adjusted free cash flow of approximately $24 billion in 2022, which is net of roughly $1 billion in SKYRIZI royalty payments. This cash flow will fully support a strong and growing dividend. We have increased by more than 250% since inception. Continued debt repayment, where we expect to pay down
dividend
just
is
above
definitely
$12
very
billion
strong.
in debt in 2022 and estimate a net leverage ratio of 1.8 times by the end of the year. Our strong cash flow also allows for continued business development, with approximately $2 billion allocated annually to augment our pipeline with the most promising external technologies and innovative therapies. In closing, we are very pleased with AbbVie's strong results in 2021, and we expect to deliver robust performance in 2022 and over the long term.
Yeah, I'm pretty pleased too.
With that, I'll turn the call back over to Liz.
Question is just whether or not they can sustain it further.
In the interest of hearing from as many analysts as possible over the remainder of the call, we ask that you please limit your questions to one or two. Operator, we'll take the first question.
Thank you. Our first question comes from Chris Schott with J.P. Morgan. Your line is open.
Great. Thanks so much for the questions. I just have a couple here digging into RINVOQ in a little bit more detail. I guess first in rheumatoid arthritis, can you just, it looks like volumes have plateaued a little bit. It's probably not hugely surprising given the label revision, but just elaborate a little bit more on the feedback you're getting from physicians there and when you anticipate you'll start to see sequential growth again in that indication. The second question I had on RINVOQ was then on atopic derm. Just elaborate again a little bit more on the ramp you're expecting here. Is this something that's going to take some time, or do you view that there's some low-hanging fruit maybe with some of the Dupixent failures? And I'm really just trying to get to with all of these is I guess the $2.7 billion guidance. How much of that's RA? How much of it's new indication? Just a little bit more color on that front. Thanks so much.
Yeah, thanks. Hi, it's Jeff. I'll give you some sense on what's happening with RA. So the RA market after the drug safety and label is progressing as we anticipated. So I'll give you some sense, and I'll refer to sort of in-play share because you have to be a little bit careful in the December-January timeframe with overall volumes in the market. But right before the drug safety communication, we had about a 16% in-play share in RA, which was just right behind Humira. So very, very strong.
Only 2 more years to go.
Trended over the fourth quarter.
Then we can take a look at my revenue model.
Okay, so it's about 14.
I know it's a long wait, but anybody who's watching, if you can please like or subscribe, it would be very much appreciated.
Very consistent with what we thought would happen. So about a 20% shift in new-to-brand starts over that time period. And what we see from the market is it's exactly as we would expect. Very, very stable, no change really in second line plus, and doctors start to suppress their starts in first line consistent with the label. So what we're going to see is that as basically the promotion kicks back in here after December in the first quarter, we're going to see that type of stability, which we can see is very, very clear from our overall share in our weeklies, and start to progress as we shift and pivot towards that second line plus. So the market is responding very similar to our expectations that we've been talking about in terms of overall RA. Obviously, PSA is going to help build upon that RA dynamic, and then ultimately later in the year, the big axial approvals as well. So everything is progressing as we've thought it would progress from a market perspective. In terms of atopic dermatitis, listen, I said in my prepared remarks, we're very pleased with the label. We have those stringent endpoints of the EASI 90, the high skin clearance, very powerful itch reduction are reflected in our label. We obviously have both doses approved. The market, I can tell you, has been very pleasantly surprised about the adolescent indication, which is it's very important. So that's basically, we're going to start to see that ramp. We don't think it's going to be slow. And to your point in terms of our ability to start to capture patients, it's happening already. We obviously haven't reported any of the TRXs yet, but we can see it in the market. And typically, it's falling into a couple of areas. First, Dupie failures, not a surprise, and there's a reasonably significant number of people after 4 or 5 years that just have failed and exited the market. They're going to come back in. We have reports from our research and our teams over partial responders to Dupie that just aren't doing well, in particular with the itch. We see some early starts there. And then, of course, challenging patients in general, we are seeing starts there as well with those higher levels of skin involvement. So the market seems to be progressing as we expected. It's not surprising that as we look at the development of the second-line market, we're going to see initially most of the starts in the Dupie partial responders or the non-responders, which is a fairly significant population. Also, as I mentioned, that we will start to see our access ramp fairly quickly here over the first part of the year. So we're encouraged. Maybe I can turn it over to Rob to give a sense over the relative magnitude of the sales.
Thanks, Jeff. Chris, this is Rob. So of the RINVOQ guidance of $2.7 billion, the AD and spine indications will each contribute a couple $100 million, while UC will contribute around $100 million. I think to keep in mind in terms of sequential growth, keep in mind in the U.S. you tend to see from Q4 to Q1 a sequential decline, so that that's just a seasonal dynamic that we see across the business. So you would see sequential growth resume in Q2 and beyond.
Thanks, Chris. Operator, next question, please.
Thank you. Our next question comes from Ronny Gal from Bernstein. Your line is open.
Good morning, everybody, and thank you for taking my question. The nice quarter. First, questions around Humira. I was wondering if you guys will be in a position to give us some sort of a floor number in 2023 based on payer contracts. Sometimes this year, obviously, the market is looking for that. And then, when I talk to payers, it seemed a lot of the decisions about what product they would use longer term will not happen in 2023. They'll happen in 2024. You kind of talked about a decline and then a quick ramp up. Do you see the floor here in 2023, or do you see it in 2024? And then if I could sneak one more, you have one of the largest differences between GAAP and non-GAAP earnings in the industry because of that Allergan acquisition. As you look at the amortization periods and so forth, when do you think this thing will begin to narrow in a significant way? Just because that's a concern for some investors.
I don't really care about their adjusted earnings. So it doesn't really matter to me. But good question for people who do.
The Humira questions. I think if you look at the guidance we've provided thus far, I think that's consistent with how we see the market playing out overall. We've said basically you should be thinking about 45% erosion plus or minus 10%. That's probably a reasonable range. Nothing has really given us any indication that it should be different than that at this point. I think we will be in a position as we move later on this year to potentially be able to provide some more specificity around that. We should be through all of the contracting at that point, and I'm in a better position to be able to understand the ramp and the change that will occur over that period of time, and we certainly want to provide guidance when we have confidence that we can give you a high degree of specificity of what that guidance looks like. As it relates to your question about will the floor for Humira, I think your question is, will the floor for Humira be in 23 or 24? And I believe you'll see further erosion from 23 to 24 in the Humira business alone. But what we have described is we return to growth on the overall business. So you have to think about it from the perspective of you have this underlying growth engine that gets suppressed in 23 by the significant erosion that you see around Humira, both price and some volume.
Yeah, we'll see that in my model.
As that continues, it continues at a slower pace when we get into 24, so the overall business has the ability to be able to drive growth for the total company. But yes, Humira would continue to decline in 24. And then, Rob, why don't you cover the third one?
Sure, Ryan. This is Rob. So when you look at our adjustments to specified intangible amortization, I'd say intangible amortization is like 70% of it. This is on the 474 guidance that we've given this year. And that will continue. Obviously, those things fall off over a number of years, but I would say, that's probably a level that I would assume would be, present for the next several years. Another big component is Skyrizi contingent consideration, given that that's purchase accounting, and we record that accretion as such. that will certainly fluctuate over time, but I'd say those are the two biggest components of the guide this year. And certainly, integration costs are starting to wind down, so you would expect to see those come down. But it is going down from last year, and so you would expect it potentially trend down. But overall, I think you can model this level going forward.
Thanks.
Thanks, Ronnie. Operator, next question, please.
Thank you. Our next question comes from Andrew Baum with Citi. Your line is open.
Thank you. A couple of questions. Firstly, on Imbruvica, as we move into 2022 and the COVID dynamic shakes out, we'll be able to see the impact of competition versus COVID. Assuming that a significant chunk of the U.S. slowing growth rate or decline is due to competition, what can be done to regather momentum against the narrative, particularly of Calquence? And then second, in terms of your aesthetics business, you terminated your contract with Medytox in your liquid formulation. There are competitive products coming to market as well as increasing price competition. How much of that is concern, or is your franchise and the breadth of the portfolio enough to minimize any impact of novel formulations? Thank you.
Yeah, hi, Andrew. It's Jeff. So thanks. And you're right that we still have the continuing lingering effect with COVID, and Rob addressed that in his comments. So we still see the market, versus 19 levels down, about 10%, and even
All right. Somewhat interested in hearing the answer to that question, but gotta move on. Done with the 10-year trend, so we'll take a look at the whole thing. I am pretty happy to have this 10K in, especially just because, like I said, I've been invested in Abbvie for a decent amount of time now, and I never had a full 10-year spread of years for their 10Ks because they split off from Abbott Labs. In the first year they did so was in 2012, and I always could have tried to resplice some numbers together from Abbott Labs. People have done that. If you really want to get older numbers from them, you can just take the section that was split off from Abbott Labs and you can do that, but I didn't ever really want to get into it quite to that level, so I was just stuck with it. But as I've said before, my whole R&D capitalization method kind of does having a full 10-year of spread to get as accurate of a measure of the R&D capitalized margin as possible. So having full 10 years is really nice now. That said, looking at the sales capital ratio, you can see, like I said, when they first came off, they had a relatively high sales capital ratio, not because it was because of their operational skills, probably because they just had too small of a capital base, and so they had to build up a capital base. As I said, they were in the 60s, they moved kind of up in the 70s or 80s before they did the acquisition, and then it's been down relatively lower. So I think it's pretty easy to argue that this is the trend over the long run is pretty logical and consistent, minus these few years right here. It's this is really the average that probably makes the most sense, minus those 3, which gives us a 0.6 sort of average. We'll see if the 0.5 kind of looks like that, 0.62. I think that's pretty reasonable to assume, though perhaps using the most recent year as an actual guideline makes sense. I can see them issuing more debt this year, but also issuing but also getting more revenues, and then the balance between whatever they do with their equity kind of changes over those things. So I can see that perhaps not really being higher than the most recent year, but we'll probably guide towards a 60 or 65 type number. I don't know, maybe we'll use the 1 year point for our base year of the sales to capital ratio. And then looking at the multiple over time, I was sort of saying that they've definitely traded up and down, and it really just kind of shows that over the longer trend, there's definitely been some good points to buy them at relatively cheap points relative to their earnings, but also points where they're trading relatively high relative to earnings that hadn't showed up yet. And the fact that it moves back and forth between those things really just kind of shows that those earnings have moved up and down. It has been a really large amount of growth for the company overall since it's splitting off from Abbott Labs. Looking at the balance sheet over the entire time frame, as I was saying before, they had gone into negative territory and then dipped back up. But you can see that they really kind of had just stuck just a few $1 billion in positive territory for most of that time before they did this. And really, it's been a large part, a lot of these large acquisitions that they've moved over time to get to this space. It's funny that the most recent and largest acquisition was the one that actually put them back into a positive shareholders territory, which again is one of the reasons it was a really good acquisition overall, even though it did cost a decent amount of share dilution to do so, which we'll get to when we get to the EPS, because that actually shows how good it was overall. Moving into the cash flow statement, I can see that the returns on invested capital, like I said, have been pretty strong over the entire long haul poll, except for these few years since the acquisitions have been done. Pretty easy to argue that it is going to move back up over time. For your average, about 16%. I'm probably fine with just leaving in that range because it probably will be higher than this number in the next most recent year, but probably not too much higher. I don't know, maybe a 5-year average would be a few points higher. I could see that, but I'm going to use the 3-year average for the baseline. And then over the cash flow, you can see over the entire 10-year period, the entire amount of cash flow they could have paid out was $69.2 billion to their shareholders, and the amount that they did pay out to their shareholders is $74 billion. So even over the 10-year period, they still overpaid their shareholders. Although, again, you can argue that that really has to do more with these years and a little bit more in the past. These last couple of years have been a little bit more of an improvement. And you can see that overall with the total common yield. There was a total common yield in not super high territory, but then it did start to trade relatively high, and it's been coming down. So we'll see if it comes down a little bit more. It was a little bit lower recently, and then you can see that the actual dividend yield hasn't changed that much. So depending on what they do with the share buybacks the next year or two will make a big difference for that. But overall, their earnings are growing pretty significantly, and they were purchasing the shares at a relatively cheap price. So there's arguments to say the share buybacks are good, even though it was a little bit more than the shareholders theoretically should have been paid. Overall corrected net margin after doing all the R&D capitalization actually gets us to 20 to 21% over the 3-year average, though that is including this 13% year in here as an average. If we use the 5-year range, that will push it up a little bit higher, though that also means we'll be including this 37% one. I don't know, just taking a look over the whole 9-year range, but that includes years that are not fully R&D capitalized, so that's probably not necessarily the best. We could probably use this as a decent baseline number, and then perhaps guide a slightly lower than this into the future, because I do think it's likely to be a little bit higher in this next year because of the projections that they've made, but then is perhaps can have a downward trend after that, as they've discussed. And then moving a bit further up, you can kind of see the overall movement of their revenues. Yeah, it's been an incredibly great time. They've literally just accelerated their 5-year trend this entire time. So it's amazing. We're definitely going to assume that revenue growth is going to come down pretty significantly, but at the same time, we're going to project some good stuff for them. And then on that front, I do have some adjustments to my model based off the things they were talking about in the call. I was just kind of like fumbling some numbers together last night when I made it, but we'll see what it looks like on the end of it. Again, don't pay attention to this. So many things that we need to adjust before we get into all of that. We're going to come down here and take a look at the cost of equity and debt to equity ratio. Okay, yeah, so debt to equity ratio is around 30% now. I'm pretty sure it was around like 40% or like 35 to 40% previously. So like I said, even though they've issued more debt, they've actually brought the debt to equity ratio down, which means they've brought their overall risk profile down. Weighted average cost of capital is pretty decently cheap, and I'm pretty sure their cost of capital has come down overall. We have to make large adjustments to the debt to equity ratio, but before we get into changing all of those future assumptions, I actually want to get into my revenue model. Now, in their financial statements, they provide this little interesting box that gives a set of pro forma financial information based off of the fact that they did the Allergan acquisition. They're basically providing what would have been the revenues for 2020 and 2019 if they had already had the acquisition in place. So you can get an idea of what their history might have looked like on a moving forward basis. So I have their most recent year of revenues right here. I put that there, and then their 2020 and 2019 revenues right there. And I look at the growth between these things, and I find out that the overall 2-year compounded growth for this between these 3 years actually comes to 7% per year. So that gets us an idea of what the business looks like as consistent growth in the most recent few years, if it included the recent additions to the aesthetic profile, which came from the Allergan acquisition, as well as the current kind of mature drug profile that is Humira, as well as the smaller amounts of growth profiles that is Rinvoq, Skyrizi, Imbruvica, and the various others. So I'm going to use this 7% number as sort of like a baseline number for what a mature, diversified pharmaceutical across multiple industry avenues could look like, and it's going to be useful for certain points later on. Now, beyond that, we also have this whole stuff over here that I've kind of put together. It looks a little weird and sloppy, but I'm going to try and explain what it is and why it is the way it is. We have the Humira. These are the revenues that were for Humira, about $20 to $21 billion in 2021 out of their $56.1 billion in total revenues. They had Skyrizi revenues around $3 billion and Rinvoq revenues around $1.6 billion. The difference after you subtract out the 3 drugs gets us 30.1 billion. I'm not going to pay attention to Imbruvica or Eclexia or whatever, however you pronounce it, or several of the others, or any of the aesthetic drugs. We're literally just going to pay attention and model off of Rinvoq, Skyrizi, and Humira, and then other as our entire other category. We are going to somewhat imply Imbruvica into what we think about Rinvoq and Skyrizi, but we're using Rinvoq and Skyrizi because they actually give us a specific set of guidance for those drugs. They imply here that they expect $15 billion combined between those 2 drugs in risk-adjusted sales in 2025. Risk-adjusted means that it's an expected value after taking into account worst-case scenarios and best-case scenarios. This is what they expect after adjusting for potential risks in 2025. So we're going to take them at their word for that, but we're going to take the fact that it's risk adjusted. 2025 gets us $15 billion for those 2 drugs. I'm going to assume in 2027, which is the year that I actually need numbers for, that we have a worst case scenario that they do half as good as the numbers that they project for that, and a best case scenario that they do twice as good as that. And this is the part I was going to actually adjust for and kind of imply a little bit of Imbruvica by shifting it up to 22.5. So what that does, it means in our best case scenario for Rinvoq, Skyrizi, and sort of Imbruvica, we have in the best case scenario $37.5 billion in 2027, and in the worst case scenario $7.5 billion in 2027. Now for Humira, we have here, hold on, I'm gonna shift this to 75. For Humira, we have a best case scenario that 75% of the revenues are lost by 2027, which gives us $5.1 billion in revenues left over. And then in the worst case scenario, we're assuming all of the Humira sales are lost by 2027, so which gives us $0 in sales. So we've put out our sales essentially for 3 or 4 drugs. They're major growth avenues of the things that are supposed to replace Humira with Humira itself. And then we have our other category. Now, the other category, this is where that other number I was projecting, the 7% comes in, is based off of kind of a diversified portfolio of drugs that includes aesthetic drugs. And so that's what our other category is. Now, I'm going to assume in the worst case scenario that they do half as much as that, 7%, and they do 3.5% per year till 2027. And in the best case scenario, I'm going to assume they do 50% better than that and do 10.5% per year till 2027. That gets me 50.9 billion in the best case scenario and 36.7 in the worst case scenario. Now you add up all these best case and worst case scenarios, and you end up with best case scenarios of $93.6 billion and worst case scenarios of revenues of $44.2 billion, which gets us a compounded revenue growth for the next 5 years of just under 11% in the best case and just under -5% in the worst case. So there you go. That's our revenue model that we're going to use for Abbvie. Like I said, I've owned Abbvie for several years, and I've never actually done something quite this specific on it. I've kind of like done a little bit of it in my head, but never really put it into an actual Excel spreadsheet. Usually I don't worry about pharmaceutical companies if they're like this diversified in that sense. But since there's so much controversy or uncertainty surrounding Humira and the fact that they're losing all their sales relative to that, I figured I'd put this together a little bit so that people can see why I guess I wouldn't have been that concerned about it, because I'm pretty sure like this range of revenues is relatively similar to what I was using last year. I think that's relatively the same. Of course, how we're going to display the probabilities between those is kind of going to be up to me a little bit, but whatever, we're going to get into that. So as I said, we'll go up here and just stop that in. -5 is already in place, but we'll bring this up to 11%. And I don't know, this is probably going to be like 7 or 8% for that number. So we'll just go ahead and throw that number in there for now. Now let's take a look at the debt to equity ratio. The current market cap is $258.2 billion. We assume that they have a pretty significant drop in market cap, probably not 50%, maybe like 33% would be a pretty significant amount for a company of this size. So I don't know, that gets us to around 170, 180. If they significantly increase their debt, you could see them possibly getting to possibly to around 100%, but that's probably too high of a worst case scenario for them. Maybe around 80% would be more logical for them. 0% is basically impossible for a company of this type. I'm going to use probably 10% for sort of a best case scenario. That implies a huge amount of market cap increase. And then, well, 25 is probably fine for where that currently is. Now, let's go and adjust sales to capital ratio, I guess, next. Like I said, we like this base of 0.53 the most recent year as for the base year, and we're kind of thinking we want to guide to like 0.6 to 0.65 or so, on the assumption that it really is going to move back closer to where it was as sort of a tendency midpoint prior to the Allergan acquisition. Not quite as high as some of these last few years before they did the acquisition, but definitely a little bit higher than it currently is. So with that, we'll probably bring this down to like 0.35. I don't know. Oh, whoops. Okay, yeah, that's probably about right for the sales to capital ratio. Now, the major change that we have to do, obviously this looks really terrible, but that's because I haven't done the margins yet, and that's the huge one that really needs adjusting, because we currently have an expected margin of around 10%, and their 5-year average for R&D adjusted margins is around 25%. So like I said, we're using the 25% on the assumption that they are going to, in the next most recent year, probably do a little bit better than this most recent year, but they're probably going to trend a little bit downward, I think, from that. I think, what was the industrial average? It was like 28%, so they are actually a little bit lower than that, and they are lower than that in the sales to capital ratio as well. But either way, that's partially just what comes from being a more larger cap diversified company, is your sales to capital ratio tends to get compressed overall over time when you're a larger player in the industry, as you end up having to like buy things up to defend your revenue space. So anyway, let's see if 25 is sort of the baseline here. I think a good worst case scenario for them is probably like 10 or 15%, and then maybe up to like 35 or 40% for a best case scenario. Yeah, okay, so that's a little high. We want the midpoint, like I said, to be a bit lower. 30%, considering their point right here, is probably not too bad. I don't necessarily want to bring the lowest point down to 10%, so bringing the cap down is better. That makes the midpoint 22.5, and if we put 25 in for the analyst number, that'll give us 23% on the expected value before we adjust for probabilities. Okay, did I want to adjust the perpetual growth or perpetual tax rate any further? No, I'm probably okay with that. Okay, so now we are going to adjust the probabilities. I do feel relatively optimistic. Typically, like I said, when I project worst case scenarios, I tend to lean more towards the optimistic end, because I'm typically trying to skew worst case scenarios in a specific way. But I mean, even so, a lot of the projections and stuff that I made in here were based off of real things that I actually think are pretty reasonably likely. I think this fourth model is pretty significantly more likely. Again, look at their growth rate over time. So even the idea that even if they do have a huge loss in the Humira sales over the course of it, I really do think that the Rinvoq and Skyrizi will do better than they suggest. They typically, in the entire time that I've owned them, basically every number they've ever provided has been sandbagged. They've massively outperformed expectations. So for me, it's pretty easy to lean more heavily into the optimistic end of things. So anyway, yeah, so I mean, that gets 65% of the probabilities leaned into these two sets of outcomes. I think that's pretty good. That's not even that crazy of a growth expectation. Let's see, that puts the expected margin 23 to 24%. That puts the implied return on invested capital around 15%, relative to around the 16% they've had more recently. Sales to capital ratio, let's see, that puts the expected value of the sales capital ratio up to 66. So if anything, that maybe pushed that up a little bit too high. You could argue that that's us being a little bit more optimistic towards them. You could argue maybe this should be brought down to like 85. Yeah, that's actually probably a little bit better. Much as I don't want to do it. What did the expected debt to equity ratio come out to be? 38.5, and they're currently 29.30. Okay, so we actually probably do want to adjust that. Let's see what 70 looks like. That brings it down to 34. So I'm willing to have it be a little bit higher than it currently is, because on the assumption that they actually just don't issue debt, but they do have their market cap come down a little bit in the short run. Let's see, I don't know, maybe put this at 20. What's the expected value at 34? Okay, I guess I'm probably okay with that. Anything else that might be about it other than the default risks? Yeah. Okay. That. Yep. Sorry, let's adjust for the default risks. So in the most recent year, it was less than 1%. Yeah, nothing too major as far as default risks go. Their interest coverage ratios are pretty good. The expected interest coverage ratios, I should say. Okay. That's it. That's about it. Okay. So that's ticker ABBV, Abbvie Pharmaceutical. U.S. Treasury selling for 1.918% or so. Mature market equity risk premium, I come up with 5.03% or so currently. And the discount rate I come up with for Abbvie after adjusting for company-specific idiosyncratic risks, I get to 8%. They currently have a dividend of 3.92% at the current market levels. 5 years ago, they had sales of $25.6 billion. In the most recent year, $56.1 billion, which gives them just under 17% per year sales growth for the last 5 years, which is pretty crazy. A little bit of a sleeping giant in that sense. Sales capital ratio for the last 3 years on average was, or actually that's the most recent year average or number, is 0.53 relative to industrial expectations of 0.69, and returns on invested capital for the last I think it was 5-year average of 15.92%, and they have a debt to equity ratio currently of 29.78%. The default risk in the most recent year was less than 1%, so nothing too major to be concerned about there. Profit margins after adjusting for R&D for the last 5 years on average has been 24.76%, relative to industrial expectations of 28.62%. So they do have relatively low profit margins to sales capital ratio compared to their industrial expectations, but within this type of industry, that's a little bit not too surprising considering how large of a company they are. They're kind of at the size and scale where they do have to invest a little bit more in order to sustain the profit margins that they actually do have, as well as grow at the same time. So it's not entirely too surprising. It's actually still relatively strong given the strength of things. And in that particular industry, there's a wide variance as well. So there tends to be a lot of companies with negative profit margins and a lot of companies with really high profit margins. So even having profit margins close to the industrial expectation is pretty good for this type of industry. They have profit in the most recent year of $12.5 billion after adjusting for R&D. And this is relative to the share price of $144.03 currently. Our probability distribution is pretty heavily tilted towards the optimistic end of things based off of this more specific research that we have and understanding we have of the revenue expectations for the company. We feel pretty safe and comfortable with these sets of expectations. And that gets us a revenue projections of anywhere from $43.4 billion in the worst case scenario to $94.6 billion in the best case scenario. And on an expected basis, we have 70.5 billion, which gets us revenue growth expectations of anywhere from -5% to 11%. And on an expected basis, we have 4.4% per year for the next 5 years, that is. Sales capital expectations of anywhere from 0.35 to 0.85, on an expected basis 0.63. Returns on invested capital expectation of 14.71% with a debt to equity projection of 34%. Default risk overall on an expected basis, we have just over 1% per year, which is nothing too major. It's over 1%, just a little bit more than you generally like, but it's just over, so it's really not too big of a deal. But either way, they can probably handle it. Profit margin expectations, we have a distribution of anywhere from 15 to 30%. On an expected basis, we have 23.63%. That gets us a profit distribution of anywhere from $6.5 billion in the 5-year forward period to $28.4 billion in the 5-year forward period. On an expected basis, we have $17 billion. That gets us, after adjusting for the discount rate that we've come up with for the company, an expected present value of $128.05, which is 11% lower than the current share price. So we have 5-year forward value targets, unadjusted for the dividends that they will be paying out during the time period, of $70.52 in the worst case scenario to $323.85 in the best case scenario. On an expected basis, we would have $188.12, which compared to the current share price gets an implied return of 5.49% each year for the next 5 years. So yeah, a little bit overvalued. I think it's a little bit less overvalued than my previous valuation. Here, hold on, let me pull that up real quick to take a look. What was it? Yeah, so my current valuation on the other sheet, I say that it's currently worth 125 or so instead of 128, and I project to 184 or so rather than 188 5 years forward. So yeah, I in this valuation, I'm saying it's worth an extra 0.5% per year currently. Is basically the improvement I see. And the difference in the fundamentals that I'm projecting, I have a little bit higher of a revenue growth rate currently in the new valuation. My sales to capital ratio is a decent bit higher. My debt to equity ratio projection is significantly lower. My profit margin projection is lower in the current valuation than the old one, which is interesting. And overall, obviously, their sales grew pretty significantly. So the expected sales that I have in the old valuation is 57.2, because they grew so much more this year than I expected them to. So now at 70.5, that's just a wholly different change in the situation. At 0.5% is important. It makes a big difference. And again, it's a 0.5% after also growing a huge amount this year. So like I said, I was projecting them to have that type of return based off of fundamentals from last year, and so they grew significantly into their fundamentals, but they also grew their share price. How much are they up now? It's like 29% over from the year over year, from the 10K to 10K, plus another 6% since then. So they're up like 36% since the numbers of the last valuation I did came out. Yeah, I mean, growth into pretty significantly. So anyway, I get a value score of 0.63, which is, I think, actually a little bit lower than the value score I had previously for them. I think that's because my profit margin expectations, like I said, I did project lower profit margins for them, which is part of the reason the value is pretty close, even though, like I said, the sales is just so much higher, because I am projecting lower profit margins now than I did last year. I think I was perhaps being a little bit rosy with them on profit margins last year. But like I said, I'm also being friendlier with them with the sales capital ratio, so that's interesting. But anyway, short-term pricing metrics, I come up with 129, which is funny. It's so close based off of the multiple regression. Apparently, they should trade at a higher PE, but they should trade at a lower price to book, lower price to sales, lower EV to capital, and lower EV to EBITDA. And on net, we get negative 10% for the pricing, which is funny that it's so close. It's not usually that close. But yeah, so that's Abbvie for you. Like I said, it is a personal holding of mine that I had been trimming. With this valuation, I mean, I'm still probably going to be trimming it if push comes to shove. It's one that I'll probably be very hesitant to. It's like the way I kind of move things around in my portfolio is like I sell things partially when I just think they're very overvalued, but it's also partially only when I feel like I need to increase my cash position in order to buy other things. And so it's like if I have a lot of cash, even if I have a few more overvalued companies, I might sell less of them. You know, I might be willing to just hold on to them a little bit more because I currently already have a decent amount of cash on hand. And so like where my cash position is kind of helps define how quickly I am to sell something. And also if I have other things I would rather sell instead. So, you know, if there's other things that are worse of an opportunity return, then I might go for that instead. And so it's like, well, Abbvie is not the greatest return thing in my portfolio, and I have lowered my exposure to it a little bit. I'm also pretty comfortable with my current exposure, and I'm not super quick to do so. But so I don't know. I can see myself selling out of this company over the next 6 months, but I could also see myself continuing to hold it depending on runs. It's only like a few percentage points of my portfolio. I'm pretty diversified, so you know, 2 to 3% position is significant, but nothing too crazy. So that's gonna do it for today. Like I said at the start of the stream, I did discover after the last stream that PPL, another company in my portfolio, had also released their 10K, as well as, like I said, we had already seen that the AT&T one was out, but I'm waiting on the Discovery one in order to do that. So we do have companies on the horizon to do. I will pretty much almost certainly be doing PPL on Monday. Unless maybe something more interesting. So that every time I say that, something else comes up that takes the place of it. So I'm a little hesitant at this point, but I think probably PPL. Thank you very much. Thank you for the likes. Please share the content if you enjoy it. Share it with other people that like it.